She always hates it when I do this. My producer. Give me 1 second, guys. My internet is being slow. Okay, and we will be right there. What is up, everybody? Welcome to the Russell Journal. I am Russell, and this is my journal entry for Monday, October 3rd, 2022. It is an interesting day in the market. After last week's nasty sell-off, we saw an equally nasty bounce in the other direction. We'll get into that, talk about this, what this means, what we're really looking for in trading, in our trade planning going forward when we go through the charts. Okay. The key things to be really well aware of: on one side, we're very oversold, right? And so the bounce is not something abnormal from a very oversold condition. Bears are going to want to take profit. If you shorted back in August and you've been holding short, it's a new quarter, it's a new month, it's a new week, and you're really far down there. So regardless of what the chart is showing, it's probably time to take some money off of the table if you're short. At the same time, you have earnings coming in 2 weeks, and nobody knows what sort of surprises you're going to get going forward into earnings. There could be some very positive stuff. Some of the stuff you may want to be looking at is like Disney has got a plan. They're not going to just go down without a fight. You're looking at a company that's been here for 100 years or more, and they're going to go down swinging. So, be looking out for that. It's going to be nothing for Disney to pivot away from all of the all of the woke culture and go back to making something different, or finding a way to get you all to subscribe to Disney Plus, or anything of that. Right. So we look at like the different companies that make up the indexes, and there's some stuff that can happen. Amazon very well likely could deliver on earnings. And at the same time, so could Apple. There are some chances there that stuff could happen. And you don't know what's happening. If you look at a company like Apple, which is pivoting out of China and into India, even if they give, okay, the iPhone 14 is not doing great, but we've pivoted into China or into India, and our manufacturing is scaling up there. And come next year, we are going to be killing it for the holidays. Or, very well likely they may sell a ton of iPhones, look to sell a ton of iPhones, or have a ton of iPhone 14 orders for Christmas or something of that nature. So you don't know whether or not this is going to happen, or they're going to at least say this. Okay. Overall, I think you're going to get earnings compression. I think that they're going to announce that, hey, earnings don't look good for next year. They're going to take the hit in the stock price, and they'll go ahead and whatever that is, they'll just roll that into some type of tax. What do you call it? The write-off. Wow, hard words to say. Tax write-off. So you don't know what they're going to do. There are a few other things that you also know that they're going to do. They're still going to do, and they are going to pay out some type of quarterly dividend. Some of these stocks are, and there are people who they live off of dividends. My father, like at least half of his income comes straight from the dividends in his stock portfolio. So even if the market's down, the chance to get the dividend for them, especially on these blue chip companies, is still better. Don't get me wrong. I'm not suggesting you go buy dividend stocks on penny stocks. What I'm saying is go look for these dividend higher. They are looking for these higher dividend paying companies. In the meantime, we have this sort of thing back in play. We saw this from the Bank of England last week, where they pivoted from their QE, or from their quantitative tightening. I'm sorry, their QT, and they bought bonds from retirement funds, from pension. They bought pension bonds. Okay. This is good and bad. If you're a pensioner, your pension is saved, but they've just introduced a whole bunch more money back into their economy that they were trying to take out by rolling off their balance sheet and raising interest rates. At the same time, they're fighting their government, who is trying to do price fixing as a form of keeping the inflation from killing their people, right? So you're really in like a weird spot where Europe's doing it, and you're also starting to see some pivots in the bond market where the bond yields really don't continue. They're calling BS. The bond yields are coming down a little bit. I don't know where they ended up today. I will definitely research that and put it around. Okay, so there's some sort of thing for a Fed pivot. Here's the problem with the Fed pivot. Listen, if the Fed had pivoted in these last two rate hikes, if that's like, you know what, we're gonna hold off, or hey, you know, we're gonna maybe lower interest, maybe we went too far too fast. The thing is those interest rates are still there. There's still loans borrowed at, money made and borrowed at that thing. It's not a lot, but there is. And the thing is there's bonds that sold based on those interest rates. And so there is debt going to become due in 2 to 10 years based on those interest rates. So there, you know, like if you're Apple sold to pay their last dividend, they sold bonds, right? And if they have to pay a higher interest rate on those bonds now, that's money that they're going to pay out of their earnings. Their profit is going to be lower, right? So really, I'm not liking the hat backwards. So really, when you're looking at this, you're going like, okay, earnings are probably still going to take a hit. Guidance is still going to be lower for next year, and with the PE multiple compression, that's one thing, and then like the earnings compression on top of that. So if you're making $100 million a year and you got a PE ratio of 100 to 1, right? And now that's your earnings expected are 50 million next year, right? To keep that 100 to 1, that price has to still get cut in half, right? It still has to come down. Now, I'm not saying it's going to get cut in half. It could get cut by 10% or something like that. So the earnings comes down even with the lower multiple, right? If it was 201, now it's 100 to 1. It's still, the price still has to come down to stay in line with that PE ratio. So there's no way there's not a compression coming, right? There's just no way, no matter what. But those PE ratios, okay, the ratio itself is a derivative of the value of the company and the earnings of the company. But what establishes what investors are willing to pay, especially big investors, the big guys, what they're willing to pay for what ratio they're willing to pay, has to do with the cost of money to them, okay? So they will push a PE ratio, they will push the value of a stock up so it's beyond the cost of what it is to borrow or what the cost of money just is in general. Whether they're borrowing or not, this is the cost of money, right? Our interest rate, say, is 3%, right? So they will try and push that PE ratio. They will be willing to pay a PE ratio, a multiple that turns them a result of higher than 3%, okay? So what really establishes what they're willing to pay for those PE ratios is the cost of money. And one of the things that you would have heard over the last 2 years is these PE ratios aren't sustainable. These PE ratios aren't sustainable. These PE ratios aren't sustainable. I am guilty of this. Guess what? If the cost of money is this and the PE ratio needs to be above here, then it's absolutely sustainable, right? Like it is absolutely sustainable because this guy has to borrow this money at this level and he has to make at least this much. So that ratio is more than sustainable, especially if you're a big guy like Goldman Sachs or Bear Stearns. Oh, no, bad choice. Bear Stearns, bad. Okay. In the meantime, speaking of banks, big banks, Credit Suisse and Deutsche Bank seem to have stemmed off the tide a little bit of how bad their earnings are going to be and how much trouble they're in and whether their investors are running away from them or not. From what I gather, it's based on the trading action today. Nobody was dumping nothing, right? We were very bullish. So going into all of that, the last thing about this, the reason we're going to bring it full circle, right? So we're talking about these banks. We talk about the pivot. We're going to talk about the banks. And now we're going to go back to the Fed again. And what we're going to talk about here is that the Fed is having a meeting with the bigger banks. And what they're talking about doing is a stress test. They've been testing to see how much liquidity the banks have and how much they're going to be able to absorb the debt, right? So what happens is the Fed bought bonds, okay? They bought debt. Bonds are debt, okay? They bought bonds, and those bonds are running off. And what's happening is the banks are having to pay the Fed for that debt. This is taking liquidity out of the system, okay? The problem is that liquidity is supposed to create reserves for those banks in order to handle the stuff in the overnight repo. So you go borrow money from the bank creates this money. You take the money you borrow and you spend it over here, okay? It gets spent, all right? So the thing is the guy you spent the money you borrowed from, he banks with a different bank, okay? He banks with a different bank. And so there's no actual real money that you borrowed, right? The bank invented that money, okay? Now, the thing is they have to take a bunch of money from their bank that they didn't invent or that they don't physically have and somehow give it to the bank of the guy you bought whatever you bought from, okay? So this is where we have this sort of transaction that happens between the bank and the central bank, okay? And what the bank does is it calls and says, hey, central bank, we need to transfer money to that bank. And so would you do that for us? And so the central bank sends the money to the bank of the guy you bought your stuff from, right? You're at bank A, he's at bank B. Central bank takes the fake money and sends real money to bank B, okay? And in order to hold that, the bank A has to put up some sort of collateral in order to get the central bank to do it. So they put up their reserves, right? They go, okay, here's these reserves, and we will transfer this to you, right? And they get the reserves back when bank B says, oh, we need to transfer money back to bank A, right? Because somebody at bank B borrowed money and paid it to guy at bank A, and so then they transfer back. Okay, reserves, this is the repo. The problem is without the liquidity, bank A, if they don't have enough money to create the reserves, they can't facilitate the transaction, right? Good news is this kind of keeps them from just creating loan after loan after loan after loan after loan, faking a bunch of money and throwing it out there because they can only really loan what they're capable of buying reserves for. Unless the central bank goes and creates a bunch of reserves for them just for cuz, which is something that has also happened. So anyway, not going to go totally completely any more into this, but what you need to see is that if the banks don't have the liquidity to facilitate those transactions, the whole thing, right? The transaction of money to central bank, to bank B, from bank B, back to bank A, right? That whole thing, that wheel stops. So what the Fed wanted a private meeting with these guys to see, one, how likely that is to stop, and two, if they can't possibly offer some sort of discount interest rate for that repo market, okay? For that, right? That's the repo market, is where like, hey, and it's overnight repo. We send you the reserves tonight. In the morning, we will get them back from you when we balance the books out, right? So the thing is like, if that stops, the transactions of money from A to B stop happening. The guy you bought something from, he's not going to get any money, even if you say you bought it and you swipe your card and it's approved and whatever, right? So that's not going to happen. So they need to keep that whole wheel going, right? And so the thing is if they're talking about doing some sort of discounted rate for this repo market, the possibility for them to start thinking about pivoting and lowering the overall Fed funds rate starts to get a little bit higher, right? Where this comes into our play with this really, really frustrating move that we're in now is that we just got the PCE inflation. It came in 0.3 higher, 0.3, I don't know, is a percent or just like dollars, like whatever, but it's higher. And so is headline inflation, which is 0.4% higher, right, than what they wanted to. That was core inflation, right? Headlines coming down, sure. At the same time, you also have one other thing happening, which is OPEC Plus is coming, and they are talking about actually doing cutting 1 million barrels of supply a day, right? Now, part of it doesn't really matter because they have these quotas, and OPEC hasn't been hitting their quotas at all. Like zip, zero, zilch. They have missed every quota for like a year straight. And so the thing is like, some of it is like, oh, well, we're going to stop producing that, and which they weren't producing anyway, and they're going to stop producing even more. And Russia last week told them, we want you to cut 1 million barrels a day. And it looks like they're actually considering cutting by 1 million barrels a day. So this means the supply goes down. Demand is still relatively high. You got inflation there, right? The Fed raised rates, so things are more expensive, but it wasn't enough to make people stop spending money. So inflation's still staying up here. Not to mention, there's a whole bunch of stuff in inflation that's not coming back down ever, right? My landlord's never calling me and going to be like, hey, we feel real bad about this inflation thing. We'd love to lower your rent. We'd love to charge you less money for your rent, right? So, apologize. So that's never coming down, right? The only thing the Fed can hope to do with my rent is for the next like 3 years, maybe it just stays where it is, like not let it go up anymore. I don't know if that's going to be the case, especially considering the fact that now my landlord has to pay more for things. So he's probably going to be looking at me going like, hey, yeah, we still got to go up, you know? So that is all kind of the big ball of wax that's here. However, there's still this bull side of things that if the Fed pivots, okay, money gets cheaper. If money is cheaper, the bulls have the ability and desire and need to expand those PE ratios. Where they're going to get into trouble is if that earnings comes down enough, it will keep a ceiling on what they can get for those PE ratios. Okay, at least for 2, 3, 4, maybe even 5 years. Okay, so we're really looking at this and thinking about what's going on. In the meantime, things are oversold, and the possibility of a PE expansion, right, is there. And so what we see today in stocks is a rally. How long it will be, Okay. This is a bear market rally. Okay. Which is pretty much the title of this video. And so what we're going to go and we're going to look at is we're going to talk about these bear market rallies because there's two things that can come out of them. They usually happen. Either A, things are just so oversold that the bulls are willing to just pay it regardless of the economic conditions. And that can cause short covering. But I'm also going to show you on the chart where I think they're taking profits and where the bears are taking profits and why. Okay. So we're going to go ahead and jump into the charts right now. And we are going to okay. All right. So going through this again. Okay. So some of the stuff I want you to see. First of all, up here, I got 10 calls on SPY 380. This is a lotto ticket that I bought for my dad. It's not me. Dad, I was telling him about the chart. He got mad and he said, hey, do this. And I love the man. So he's going to, if it fails epically, then he'll hook me up. Okay. So don't worry about this. This is not my trade. I would not do this, but okay. All right. We are going to go over here. In the meantime, we are going to go to SPY or to the VIX. All right, looking at the VIX, we closed down today. I can't do it from the camera. So we closed down today 30.10. Yay. Some things to notice. I'm going to wheel in here. Okay. This. All right, let me get out of there. All right, this candle here is a fairly engulfing candle. Okay. It is not an outside candle though, but we could potentially catch another continuation of this. The other thing that I want you to notice is momentum is headed to the downside. And when we turn the MAs on, we will see how we are faring as far as that goes. Okay. We're going to turn the MA on. Okay, I put a few other lines in there just to give us some space. You know, this is like the 13 and the 9. Really what they'll be targeting, the guys who trade this, they probably sold calls up here into all the fear, and they're probably selling it down at least to the 18. And they'll probably look to take some sort of profit if they're shorting the VIX right here around the 18. More than likely what will happen is it'll get to the 18 and then you'll catch a bounce from there. So they will, if you are short the VIX, they will probably more than likely be covering right there and look for a bounce, which should give us a pullback in the indexes. The one thing you want to notice about this is there's a lot of space still between the 18. So you could probably, if you sell down to this tomorrow, there's a pretty good chance you will get a continuation of the rally from SPY, right, from the S&P. And we will go look at that and pull it up. In the meantime, okay, so we still got our trend is up. We got our bias is up, but our momentum is giving up the bullish embedded reading. So you're out. You're no longer trying to go long this, okay? Doesn't necessarily mean if you're trading this, it doesn't mean you really want to short the VIX. Because anything could happen in here until you negate the trend or get underneath the 18. You know, you really can't short this safely. Okay. And so that's kind of where you're at. Again, like I said, probably targeting the 18 for a bounce. You know, so the chances of follow through on the rally from today for yesterday in SPY still pretty good. So that's part of Dad's reason for that. Going to DXY, we're going to look at the dollar. Again, you're still looking at a dollar shortage here, and you have the concern of China dumping money in. Here's some stuff that you can see that is pretty interesting. We got our trend is up our bias is still up. You're still above the 18, right? And this is where, like, notice, the thing we talked about with the VIX, where you're going to get some type of bounce here, right? The DXY gave you a bounce. Funny how it lined up almost perfectly with this previous high. So I would be surprised to not see the bulls try and run this up even higher, just because. And we will turn on. We'll turn on the Bollinger Bands. And they're probably targeting back again this this 114 area. That 114 level up here at the upper Bollinger Band, if they're long. If you're short the dollar, you'll probably be trying to target this. Again, at the 18, you're still biased to the upside, especially notice the green candle. And so, but if it does break below here, you'll probably be looking at a short position targeting this down here, okay? Again, pullback in the dollar. There's a couple of things about this. One, it might be signaling a pivot for the Fed. They may actually be considering the idea that the Fed is going to pivot. Strong dollar has not been good for other countries around the world. It would probably not hurt the entire planet for the Fed to cool down a little bit as far as their rate raises go. But we will see. We've got some CPI data coming out this month. We've got GDP numbers coming out. We a whole bunch of stuff coming out that if it's bad, the Fed won't pivot. They will hold to it. I don't know whether Powell has the audacity to do a Paul Volcker, like to really hold strong. And I'm going to take this right now. Watch tomorrow's episode. If you're watching this episode, watch tomorrow's episode, because I'm going to go over what's called the doom loop tomorrow. And so be sure to hit the like button, subscribe, hit that notification bell. Tomorrow's episode is going to be really cool. We're going to talk about the doom loop, and from that, I'm off of that a brief history of American economics that really demonstrates that. But tomorrow, absolutely check out tomorrow's episode. It's going to be fantastic. I'm actually really excited. It's something I've wanted to talk about for a really, really long time. Oh, our candle just went red. Did it go red? Okay, you're colorblind now. So we're red now. Okay. Again, still holding above the 18, which is still a pretty bullish sign. You could probably actually set your risk if you wanted to trade the dollar, set your risk at the 18. Okay. Jumping into SPY, we're going to go back over here, and we're going to go to some stuff I talked about on the monthly chart. Okay, those were where the Bollinger Bands were, all the different ones. Okay, this is the monthly chart of the of the thing, okay? Now, typically what you will see is you will see a selling down to the lower Bollinger Band or a buying up to. And what you will see happen when you get here is you will typically see a green candle or some sort of buying. You will start to see buying pressure, okay? What happens is the market maker wants to keep the price action really between these two bands, okay? And at this lower Bollinger Band, okay, is a pretty good place to take profit, because it means that you don't have the market maker working against you. And a lot of what probably happened in here today is the market maker pushing this up to keep it inside, trying to keep it inside of the band, right? And so you could very easily wind up locked in this range, just chopping around for the rest of the month, while the market maker, while this band either expands or gets something moving back in the upward direction. So I'm going to expect that SPY is going to get fairly choppy here in the next couple of weeks, especially with earnings coming up. But we're going to go back and do our normal garden variety stuff. Okay, so trend still is down under the 18-day moving average. Bias is still down. Okay, momentum still embedded, right? So what we know here is that the bears are probably going to sell this. Okay, it would not be now again with the VIX possible continuation to the 18. This thing could still rally up, and we could get out of this. If this comes out, the bulls will be targeting the 18-day moving average. Right now, what I would say is the bears are targeting the bears are probably loading up shorts, targeting the 352 area, basically on the daily. That is where they'll be looking to get cover their shorts. They also might be targeting. They also might be targeting this lower Bollinger Band on the weekly. That would also be a pretty good get at 354. So it's going to be a little weird because the daily Bollinger Band is below the weekly Bollinger Band. You will definitely have to maintain an embedded reading. One of the problems here, though, is if this stays oversold, if it stays oversold for 3 days, it'll be embedded, or for 3 weeks, it'll be embedded. Let's go see how many weeks of oversold we got. Oh, you're nowhere near it. You like both lines are nowhere near down here. You got to get both lines underneath the oversold part for this to basically really tank for on a weekly basis. So again, mostly they don't trade on the weekly; they trade on the daily, especially longer swing positions. So I would fully expect to see. If the VIX doesn't pull back tomorrow, I'm definitely if we don't get a continuation of the VIX, I'm definitely expecting the bears to try and sell this, or at least step in on Wednesday and start to sell it. I'm hoping for Wednesday. I would like to catch a ride up to the 18 and be able to short it from right here. As of right now, my target entries are kind of right here at the top of this one as far as a put position goes. I would like to short from this spot. And these two here would be really ideal for me. These two positions, this spot here. Yeah, that's just too. It's begging us to short it, guys. So, but you can catch this bull rally, and the good news is if I short from here, I can set that 18-day as my risk level, right? And a break above that, a daily close above that, I just stop out of my trade. So it's fairly safe to short once you get up here, and I'm really hoping we do, and it really could sort of do that, especially before we get our major economic data. So let's get back over to the studio. So anyway, I'd just like to thank you guys all for checking out the show. Again, like I said, please hit that like, subscribe. I am dying to get to 100 subscribers. When I get 100 subscribers, I can do some custom stuff with the channel, which is really exciting. So please share my videos, get out there with your friends. If we get to 100, I would probably do something, I don't know what, but I will think about it as far as creating some sort of thing, some sort of giveaway, or some sort of, do something crazy. So really, sorry, I'm getting fading out here. Anyway, like I said, thanks for checking out the show. The Russel Journal is written, edited, and hosted by me, Russel Liss. We are produced by Social Media Shows. Our executive producer is Pureza. Check them out. They are a wonderful company. They can help you guys produce a show if you're interested. And until tomorrow, you guys just pretend I said some sort of catchphrase.